Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 7th, 2025. I am Luna.
I am JPMorgan. All right, so let's start with this rally then. It seems a bit surprising. How did we get here?
Well, you had both the S&P 500.
Our broad market barometer.
Right. And the NASDAQ composite, home to a lot of big tech innovators. They both closed at all-time highs. And the Dow was right there too, just shy of its own record.
So what fueled this surge? What was behind it?
Well, there were really two main engines that stood out. First, there was this wave of optimism around potential trade agreements.
Okay, hope for breakthroughs there.
Yeah, investors are hoping. And second, we got that surprisingly strong June jobs report.
Right, I saw that. 147,000 jobs added.
Yeah, significantly more than the 110,000 expected. And this isn't just numbers, right?
No.
It's a powerful counter-narrative. It shows consumer robustness it's letting investors largely shrug off those recession fears.
At least for now.
For now, exactly.
And which sectors really benefited the most from this optimistic mood?
Tech stocks, for sure. Especially the mega caps, NVIDIA, Microsoft, Amazon. They certainly led the charge.
Okay.
But also, interestingly, renewable energy shares saw a big boost.
Why was that?
Well, it was largely down to lawmakers omitting new taxes on clean energy projects from a major bill.
So that signaled support for the sector.
Exactly. Strong support.
Okay, but even as stocks were soaring, we saw this seismic shift hit another critical area, oil. Over the weekend, OPEC Plus shocked everyone, agreeing to boost production.
Yeah, by 548,000 barrels per day starting in August. Quite the surprise.
What was the immediate fallout from them basically opening the spigots?
Well, the immediate impact was a sharp plunge in international oil prices. US WTI dropped under $66 a barrel. Brent is trading near $68.
And for our listeners, what does that mean?
For you, this is largely positive. Cheaper oil usually means lower gas prices at the pump eventually.
Right.
And it helps cool inflation, which, policymakers definitely welcome right now.
Okay, that sounds like great news for consumers. But does this OPEC Plus move have a downside? Is there a catch?
Oh, absolutely. While it's good for the broader economy, it's a pretty significant headwind for energy sector stocks and U.S. shale producers, too. OPEC Plus is clearly trying to squeeze out lower margin competitors.
A power play.
It really is. And some forecasts even suggest oil could sink down towards $60 by the fourth quarter. So clear winners and losers there.
Okay, so we've got soaring stocks, plunging oil, and then there's this other thing looming, that July 9th deadline.
The ticking clock.
The U.S. deadline for global trade negotiations. President Trump has stated that new higher tariff rates could hit August 1st for countries without a deal.
This feels like the biggest overhang, doesn't it?
It definitely is the big unknown.
Right.
And what's fascinating is how markets are playing this sort of tariff puzzle.
How so?
Well, on one hand, you've got this optimism about maybe getting some mini agreements, and that's actually helped fuel the stock rally we just talked about.
Right.
But the flip side is failure to secure deals could trigger a tariff shock.
What should it mean?
More downside risk for U.S. growth, potentially pushing inflation higher. You see European and Asian nations really scrambling right now to reach agreements, trying to avoid those tariffs.
Okay. And just to add another layer here, the U.S. dollar index, the DXY, it's struggling, isn't it? Near a 4-year low.
It is, yeah, languishing near that low.
It's driving the dollar down. And again, what does that mean for us? Well, the primary drivers are uncertainty and hedging right before that tariff deadline.
Okay.
Investors are reducing their exposure to dollar assets. Basically, they're selling dollars to buy what they see as safer bets.
Like what?
Gold, for instance.
Yeah.
It's hovering near historic highs around $3,310 an ounce. And the Japanese yen is also showing significant strength against the dollar. It's that classic flight to safety.
So how does a weaker dollar impact the listener directly?
Well, for you, a weaker dollar makes things like foreign investments or international travel more expensive.
Okay.
But the flip side is it can boost earnings for U.S. multinationals. It makes American exports and tech companies more competitive globally. So it's kind of a nuanced picture.
Okay, so summing this up. We're seeing a market that's navigating some strong fundamentals, solid jobs, earnings, but also facing these pretty significant policy risks, especially around trade. What's the bottom line here?
The July 9th tariff deadline is, without doubt, the single biggest near-term risk. You should expect swift market swings based on those headlines.
Volatility.
Exactly. And while lower oil prices are a positive stabilizer for the wider economy, energy stocks could see, a continued rotation out of them.
So the advice.
Our advice to you is really to stay vigilant. Consider diversification in your portfolio and just be fully aware of the potential for increased volatility in the coming days.
It sounds like the next 24 to 48 hours are going to be pretty critical there.
They really are. We'll likely get much more clarity on the U.S. trade stance by midweek.
Okay.
So maybe here's a thought to chew on. The market right now is riding this wave of, let's call it, sunny optimism.
Mm-hmm.
Will that optimism actually be justified by what happens next? Or are we headed for more of a reality check? Staying informed will be absolutely key to navigating whatever comes next. It lets you act or maybe not act according to your own comfort level with risk. Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver days key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.